to go?
Yes.
Okay, hi, this is Andy Young with HCDC, and this is our first attempt at doing a Facebook Live interaction where I'll be trying to answer questions you may have about the SBA 504 program. So I think anybody probably getting on Facebook watching this would know a little bit about the 504 program, but briefly, it's a loan program through the U.S. Small Business Administration that is used in conjunction with third-party lenders to help small businesses buy, build, acquire fixed assets, primarily owner-occupied real estate. So with that, I'll be happy to answer any questions that may come in. And
Let's see. Okay. What's the definition of a small business as defined by the U.S. Small Business Administration?
Okay, well, the SBA, which is tasked by Congress to come up with the definition of a small business, actually has two different categories depending on the loan programs. And the interesting thing is that the definition for small business is not only used by the SBA, but all federal agencies and the government that need to deal with small businesses. And so the 504 program has a fairly easy definition of a small business, and that is a business, and any affiliated businesses cannot have a net worth greater than $15 million and profit after tax for the last 2 years of more than $5 million. And that definition goes across any type of business at all. Now there's an alternative size standard for small business that the SBA has, which was primarily used in the 7A program, which breaks out the size of the business by NAICS code. And depending on the type of industry it is, that could be the number of employees or the amount of revenues the business has. So it used to be 7A had one standard, 504 had another standard, and then recently the SBA changed that, and so we can use either one to qualify a business as a small business.
Okay. Let's see what other questions we have. So what is required to qualify for an SBA 504 loan?
Well, when we look to qualify for a 504 loan, we're really looking at both an eligible business and an eligible project. And so, like we said, the business has to be a small business, so we make sure that the business is under the size standards. We have to make sure that the business is an eligible business because not all businesses qualify, most do, but SBA has some restrictions. For example, we can't make a loan to a nonprofit business, so not all businesses qualify. And then we have to make sure that what we're asked to finance is actually an eligible project. 504 is primarily a fixed asset program, so what we're looking to do is finance real estate or long-term equipment and some of the expenses that are related to that project. So again, it's both eligible business and eligible project determines whether we can move forward with a 504 loan.
Okay. Let's see. What does a small business have to put down for an SBA 504 loan?
So for the down payment for a 504 loan, it kind of depends. And so in most cases, the down payment is just 10%. In that structure, the third-party lender, which is usually a bank or a credit union, but actually could even be an individual, generally puts up 50% of the project cost, and then the SBA will do 40% with then 10% down from the borrower. However, there are some circumstances where the SBA does require a higher down payment And that is the case of what they consider to be a single purpose type property or a startup business. So a single purpose property would be a gas station, a hotel, a golf course, car wash. And in those cases, the requirement is 15% down, and the third-party lender must do 50% of the project cost, with the SBA doing the balance. In the case of a startup business, an SBA considers a startup business to be a business that has less than 2 years of operations. Again, the down payment requirement is 15% with the 50-35-15 structure. We do have situations where it could be a startup single-purpose property, a startup gas station. In that case, the down payment requirement is 20%, the third-party lenders at 50%, and then the SBA is 30%. Now, in a case where we're not talking startup, we're not talking single-purpose, and the minimum requirement is 10%, a borrower can put more than 10% in if they would like. So in certain circumstances, a borrower might say, well, I want to put a little more down. In that case, we could have a structure where the bank is 40%, the SBA is 40%, and the equity is 20%. But in no cases can the SBA loan be more than the third-party lender loan.
So can you talk about, this is my question, can you talk about why HCDC has to be involved in the loan? Because you say the SBA puts up 40%, but HCDC is the one managing that. So can you talk about that?
Sure. Well, when the program was started back in the early 1980s, it was decided that it would be offered through local economic development organizations like HCDC. So in order for a business to get a 504 loan, they must work with a certified development company in their area. When HCDC started, our territory was exclusively Hamilton County outside the city of Cincinnati, and now our territory is the entire state of Ohio, the entire state of Kentucky, and a little corner of Indiana and the greater Cincinnati area. So by law, 504 loans are offered through CDCs, and currently there's probably about 200 active CDCs in the United States that provide the loan. So the HCDCs, the CDCs are kind of the agency that's going to deliver the program and acts as the middleman, so to speak, between the borrower and the SBA.
Thank you. So since the SBA is an economic development program, correct?
Correct.
So talk about job creation. I mean, how many jobs have to be created?
So this is one of the differences between the 7A program, which is an SBA business financing, and the 504 program, is that 7A is considered to be a business development program, the theory being that a bank or lender without the SBA participation would not be able to make the loan. The 504 program is different in that it is an economic development program. And so we can make loans to, frankly, very strong businesses. However, the SBA requires that there be an economic development justification to make the loan. Primarily, that is job creation. So currently, the SBA requires that a business getting a 504 loan will reasonably project that they will create one new full-time job within 2 years of the completion of the project for every $65,000 of SBA funds in the project. And so a business would come in and say, I'm a growing business, I need a bigger building, I'm going to be adding jobs, and as long as we can show that reasonably we're going to be getting that one job for $65,000 of SBA financing, that would qualify the business. Now, that's not the only economic development criteria that the SBA has, and there's some businesses that may not be creating enough jobs to meet the job creation category, but still would qualify for a 504 loan. And the SBA has a number of public policy or community development goals that will enable a business to also qualify. And a few of those would be if it's a women-owned and controlled business, a veteran-owned and controlled business, minority-owned business would all qualify. Not to say that the SBA doesn't want them to not create jobs, but they don't need to meet the same criteria as other businesses. Businesses in rural areas are currently something the SBA is very interested in helping and automatically qualifies for a 504 loan. Manufacturing businesses or other type of public policy where we're trying to help manufacturers. So not every business is going to create jobs, enough jobs to qualify for 504 loans, but there's sometimes we're able to qualify that business through other economic development means.
So is 504 loan interest rate, is it fixed or is it variable?
Well, one of the advantages of the 504 program is the CDC, HCDC for example, is able to get our money from the private markets because of we are able to get an SBA guarantee on our loan. So the SBA, the government, is not writing a check for these loans. It's actually fully funded through the private market. And because of the SBA guarantee, there's a ready market for purchasing our loans. Now, that being said, 504 loans come in really three flavors. We have a 10-year term, we have a 20-year term, and a 25-year term. And again, we're looking for real estate primarily, long-term fixed assets. So we're not making short-term loans, we're making long-term loans. So once the SBA approves a client, a business for the financing, we step back and the third-party lender generally then acts as the initial financing to buy the building, build the building, buy the equipment, or whatever the project would be. And it's when the project is then completed, the 504 loan is then closed through HCDC. Our loans, our funded loans, are then submitted to the SBA where they are pooled with other loans, 504 loans around the country for a monthly bond sale where anywhere from $200 to $400 million of these 504 loans every month are then taken to the capital markets for sale. And I believe Bank of America is a participating lender that would then purchase the pool of loans, pick up the SBA guarantee, and then sell them to private investors who are looking for a 20-year fixed rate instrument that's 100% guaranteed. So that being said, one of the advantages of the 504 program is we are able to offer 10, 20, or 25-year fixed interest rate loans, fully amortizing to a client. The current rates today, based on our last sale in August, was 5.3 for a 20-year loan and 5.35 for a 25-year loan. So very attractive for a business looking to acquire real estate and lock in a long-term fixed interest rate through the 504 program.
How are interest rates set?
Well, again, the interest rates are set once the pool of loans are then sold to the private market. So every month, the interest rate is going to be slightly different from the month before. We use, on the 20-year loans, we use the 10-year treasuries kind of as a basis, a starting basis point to set the loans. So that is one of the things that when a client comes in and they're getting a 504 loan, they won't know what their interest rate is until the project is actually completed and the loan is funded. However, because we track the 10-year treasuries, rates tend to move up and down very slowly, and frankly, while rates have gone up over the last year from the high 4s to the low 5% range, they're not going to be a big jump from one month to the next generally. So a client, as they're getting near completion of the project, generally knows what the interest rates are going to be for their loan.
What would I need? What documents would I need to submit for an application?
Well, the documentation for the application is very much the same as any business would provide to a conventional lender for the same project. In most cases, we're looking at a structure where we have an eligible business, a small business, which is going to be the tenant in the building, occupy the building, and I would say probably 95% of the cases we have the owners of that business will set up a separate business to actually be the borrower and the owner of the real estate. So we have generally we're working with two entities for the application. We're working for the borrower, who's going to be the owner of the real estate, in SBA speak, and that is called an eligible passive concern. And then we have the small business, which actually makes the loan eligible, which is the tenant in the building. And so initially we're going to be getting documentation on both the eligible passive concern, the EPC, as well as the operating business. That could be tax returns for the last 2 or 3 years, interim financial statements. We're going to get personal financial statements on the owners. Any owner of 20% or more of either the EPC or the operating company has to be a guarantor, so there's documentation we would need from those owners, tax returns, personal financial statements. Generally, the SBA is going to want to see what is the project, and so if we're buying a building, they're going to want to see a purchase contract. If we're building a building, we're going to want to see a purchase contract for the land and construction estimates from a contractor. We need a participating lender, so we generally would need a term sheet or a commitment letter from our participating lender who's going to be being involved in the project with us. Generally, we need appraisals on the property so we know what our value is going to be. And if it's real estate, we always would need some kind of environmental report. Could be as little as an environmental questionnaire signed off by the seller to a phase 1, and in some cases maybe even a phase 2 depending on the property.
What's a phase 1 or 2?
So the environmental reports kind of come in for us basically 3 flavors. If somebody's buying a property that, say it's a house, a residential house that's currently been zoned commercial, and they're going to put an office in it, and it's surrounded by other houses, and there's nothing really around that would be an issue, we're able to generally qualify the SBA's environmental requirement by getting a questionnaire, which would be a statements from the seller about the prior use of the property. And then we can get what's called a record search with risk assessment, where an environmental company would basically look into the environmental records for that property and make a determination if the property would be a high risk or a low risk. And if it comes back as a low risk, and we don't think there's really any environmental problems with the property, that is generally acceptable by the SBA and meets their environmental requirements. Sometimes we can't tell though. Maybe it's the prior use to the property, it's a manufacturing building that's been around for a long time, we don't really know the history that well, and so then we would probably go to a phase 1 where an environmental company would actually come in and do a more in-depth analysis for the property, where a RSRA could run anywhere from $350 to $500. A phase 1 could be anywhere from $1,500 to maybe $3,000 or $4,000. And then the environmental company would make a determination on whether the property is acceptable or not. And sometimes if not, they'll come back and say, we really can't tell and there needs to be further testing. And at that point, there would be what's called a phase 2, where actually maybe soil samples were taken or other sampling was taken in order to determine whether the property was clean or not. So RSRAs with environmental questionnaires, phase 1, and maybe a phase 2 is generally what we see to meet the ESB's environmental requirement as part of the application.
Are there any insurance requirements?
Well, generally for a closing, we're going to need title insurance, and that would be something that would be fairly standard for any kind of commercial closing. And then we would need insurance on the property that would be our collateral. If we want to make sure that if the building burns down and our collateral is damaged, that there's insurance that would be able to take care of the loan or rebuild the building. Sometimes we do need life insurance on the owners of the property. And that generally happens when there may be a single owner where we would need what's called key man life insurance. That if the owner of the property were to pass away, then the life insurance would be able to pay off the loan, because there's some risk that if the owner would pass away, that the business would not be able to continue. Generally, if there's more than one owner and we can show that that the death of one of the owners wouldn't necessarily be a cause of the demise of the business, or there is a very solid succession plan, we're able to not need life insurance. But if it's a single owner and there's not a good succession plan, then we sometimes do need life insurance on those owners as part of the collateral for the loan.
Do you do franchise businesses?
A lot of the businesses that the 504 program finances are franchises. They could be franchise restaurants, they could be franchise hotels, even gas stations, while not strictly a franchise, are considered to be franchises by the SBA. And so when we run into a situation where it's a franchise business, currently the SBA has a kind of a very strict policy on getting those loans approved. They are concerned about control of the business. Again, we're talking about small businesses, and the SBA has to ensure that our client is a small business. And so when we're in a franchise situation, they make sure that the franchisor does not have too much control over the franchisee that would cause an affiliation that potentially would make that our client, the franchisee, no longer a small business. And so currently what the SBA does is they have a franchise registry, which is on sba.gov, where they have cleared a number, I think at this time several hundred or more franchises, where they've looked at the franchise documentation and made a determination that there's no issue that would cause affiliation between the franchisor and the franchisee. So at that point, if a franchise business is on the franchise registry, we're able to proceed with the financing and make an application to the SBA. Every once in a while, though, we get an application from a franchise, might be a smaller franchise, or it could be a fuel jobber that is providing fuel for a gas station that is not on the franchise registry. And we're not able to proceed with a financing request until those issues are resolved through the SBA. So if anybody is looking to potentially apply for a 504 loan and they are a franchise, they need to make sure that that franchise or that fuel jobber is on the franchise registry before we can move forward with them.
Where do you find the franchise registry?
The franchise registry is located on the SBA website. which is at sba.gov. And if you just type in franchise registry in the search, that'll take you there.
Okay. Do you do refinancing?
Traditionally, the 504 program was not a refinance program, but in the last year, the SBA changed the rules to allow businesses to actually use the 504 program to refinance existing commercial debt. Some of the qualifications are that the business must have a commercial loan on the property that's been out at least 2 years, and they must have been current on those payments for at least the last year. The other thing with the refinance program is that the business must meet the SBA's economic development requirements. So that's either job creation or one of the other public policy goals that I talked about earlier. So we currently have made 2 refinance loans this year. One was to a woman-owned business and one was to a business in a rural area, which was able to qualify them for refinancing. The other thing about the refinance program is that it not only allows businesses to pay off and refinance with a 504 loan and another third-party loan their existing debt on the property, the SBA does allow clients to take some equity out of the property for business expenses to be used in the business. So some of the money can be used for, say, lease payments for the next year or payroll or working capital in the business. So it not only allows a business to lock in currently a long-term fixed rate with the 504 loan, but actually get some cash out to be used in the business.
Are there any penalties for paying off a loan early?
Well, as we said earlier, the 504 loans are actually sold to private investors who are looking to get that 20 or 25 fixed rate loan with the SBA guarantee. And so they're happy because they can get a better rate of return on investing in 504 loans than they would by just buying a treasury bond, but they're equally secured by the federal government. However, the folks that are buying the bonds are not interested in getting prepaid, and so if a client was looking to prepay their loan, there is a prepayment penalty for the first 10 years on either a 20 or 25-year loan currently. The prepayment penalty is based upon the underlying debenture rate, which today would be about 3%, and that prepayment penalty goes down by 1/10 each year. So for an example, if somebody was to get a loan today and they wanted to prepay in the first year, the prepayment penalty would be roughly 3% of their outstanding balance. The next year, the second year prepayment would be 90% of 3% of the outstanding balance, and then it's 80%, 70%, and then after 10 years, there is no prepayment penalty on a 504 loan. However, unlike conventional financing, the SBA doesn't have a way of allowing somebody to partially prepay a 504 loan. So you're either going to pay your loan off through the 20 or 25-year period, or you're going to prepay in full at some time. And we tell clients that if they want to pay down debt early, generally they can do that on the third-party lender loan, which is in the first position on the property. The banks generally don't have a problem with some partial prepayment on that debt.
How would I go about applying for a 504 loan with HCDC?
Well, clients basically apply either directly through their bank that they generally deal with and approach their bank first, or they can come to HCDC directly and apply to us directly. I would say get HCDC and us involved early in the process, because there are obviously some nuance in the 504 program as far as eligibility and what's for the business, eligibility for the project, things like that. And the sooner that we're involved in it, the sooner we can make a determination whether your project would even qualify, or if it does qualify, what we're going to need to get to the SBA to meet their requirements. And the SBA application requirements, while generally the same as our third-party lender, there are some differences, and the earlier that a client knows about that, the better. So again, call your bank, talk to them about a 504 loan, call us. Either way works. Now, as far as kind of the timing for a project, we're required by the SBA to have a project review committee, basically a loan committee that would initially review the request to make sure it's something that HCDC feels comfortable about submitting to the SBA. Generally, the committees meet either once every 2 weeks, or depending where it is, maybe once a month. We currently have 3 committees. We have a Kentucky committee, which looks at loans that are being done for projects in Kentucky. We have a Southern Ohio committee, which is for Greater Cincinnati, Indiana, or basically anywhere in Ohio. And then because we have a second location in Canton, Ohio, there is a Northwest loan committee that is familiar with that territory and reviews loans that are in that part of Ohio. Once the loan committee gives their approval, we then work on getting a package together to go to the SBA. And like we talked about, we need the appraisal, an environmental, third-party commitment letter, project cost, so the SBA knows what the project is. And so by the time the SBA gets it at their processing center, the project's pretty well packaged up, and anything they would have questions about would be right there. They're not going to basically be getting a half-baked deal. They're going to be getting something that's ready to be approved. The SBA has a processing center in Sacramento, California, so our applications are electronically forwarded to the SBA. And generally, if everything goes smoothly with the approval, we're getting SBA approvals back within, say 4 to 5 working days. At that time, they issue basically 3 approvals. We're going to get what's called an authorization and debenture guarantee, which is the SBA's authorization for the loan and the funding. We're also going to get a second approval, which is the approval for the environmental report. And then we're going to get a third approval, which is the appraisal approval. So the SBA will be issuing 3 approvals to the third-party lender. Once they get those approvals, then the project would be ready to close. And depending on what it is, we may be closing concurrently with the SBA, with the third-party lender, if all we're doing is buying a building, or if it's construction, major construction, the 504 loan could be closed in 18 months or even 24 months. The SBA authorizations are actually good for 48 months. So once the SBA approves it, that authorization is good for 4 years.
Okay. What's HCDC's phone number?
Our phone number, if you would like to reach us, is 513-631-8292. We have myself, Andy Young. There's Mike Crow is a loan officer here in Cincinnati. Angie Howard is another loan officer in Cincinnati. And Jeff Hassopus is our loan officer in Canton. And I don't know Canton's number right off the top of my head. You can certainly come to our website, hcdc.com. Applications are on the website, phone numbers are on the website, our smiling pictures are on the website, I believe. Feel free to give us a call, run deals by us, questions. We're here to provide a lot of free advice in order to make sure that what you may be looking at as a potential 504 project would actually fit the bill.
Well, thank you very much, Andy, for sharing your SBA loan expertise with us. and we will talk to you again soon.
Well, thank you, Casey, and thank you for everybody for joining us.